Are you ready to dive into the world of cost accounting techniques? This video explores marginal costing, a crucial concept for business operations. Discover how understanding costs can enhance profitability. The aim of this unit is to develop cost accounting skills. Learners will gain an understanding of the importance of costing to the effective operation of a business organization. This knowledge is vital for making informed financial decisions. Marginal costing, also known as variable costing, separates fixed costs from variable costs. This technique provides insights into the profitability of individual products. Only variable costs are considered in the cost of goods sold and inventory valuation. Fixed costs are treated as period costs and expensed when incurred. This approach aids in better financial analysis. The core concept of marginal costing is distinguishing between fixed and variable costs. Variable costs change with production levels, while fixed costs stay constant. Focusing on variable costs helps in decision-making by revealing the contribution margin of each unit sold. This method is crucial for understanding product profitability. The contribution margin is the difference between sales revenue and variable costs. It shows the amount available to cover fixed costs and generate profit. This metric is key in determining product profitability and making pricing decisions. It also helps in deciding product mix and discontinuation of unprofitable items. Marginal costing is simple and relevant for decision-making. It excludes fixed costs from product costs, clarifying the impact of sales volume changes on profitability. This makes it valuable for short-term decisions like pricing strategies and special orders. Its simplicity aids in quick financial assessments. Marginal costing has limitations, especially in long-term decision-making. It may distort product profitability as it ignores fixed costs. This method does not comply with generally accepted accounting principles. Therefore, it is not suitable for external financial reporting. Use it alongside other methods for a complete analysis. In summary, marginal costing is a valuable technique focusing on variable costs and contribution margin. It offers simplicity for short-term decisions, but should be used with other methods for comprehensive analysis. This ensures accurate financial reporting and strategic planning. Marginal costing is a method in managerial accounting analyzing production volume's impact on costs. It separates variable from fixed costs, showing cost behavior changes with production. Variable costs vary with production levels, including materials and labor. Fixed costs remain constant, like rent and salaries. The principle of marginal costing considers only variable costs for goods sold and inventory valuation. Fixed costs are expensed in the period incurred, not allocated to products. This focus on variable costs clarifies the contribution margin, the difference between sales revenue and variable costs. It aids in profit generation after covering variable costs. Marginal costing aids in decision-making, like pricing and product mix. It shows how production volume changes impact costs and profitability. This method highlights cost behavior and contribution margin. Useful for short-term decisions. Use it with other methods for comprehensive financial planning. Marginal costing provides insights into decision-making by focusing on cost behavior changes. Key situations include pricing, product mix, and special orders. It helps in evaluating profitability and resource allocation. This method supports informed decisions to maximize profitability. Marginal costing aids in pricing strategies by revealing product contribution margins. Managers set prices to cover variable costs and generate profit. This method helps optimize product mix for profitability. It guides resource allocation to products with the highest contribution margin. When considering special orders, marginal costing evaluates profitability. It compares the contribution margin from the order with incremental costs. This analysis helps decide on accepting or rejecting orders. It ensures that special orders contribute positively to overall profitability. Marginal costing assists in deciding whether to produce internally or buy externally. It compares variable manufacturing costs with purchase prices. This helps determine the most cost-effective option. Managers use this analysis to optimize production and purchasing strategies. Marginal costing evaluates the profitability of continuing or discontinuing products. It analyzes contribution margins and unavoidable fixed costs. This helps identify unprofitable products and decide on their continuation. It ensures resource allocation to profitable ventures. In limited resource situations, marginal costing identifies the most profitable use. It focuses on products with the highest contribution margin per unit of the limiting factor. This maximizes profitability by prioritizing resource allocation. Managers make strategic decisions to optimize output. Marginal costing analyzes sales volume changes on cost and profitability. Managers conduct sensitivity analysis to assess different scenarios. This helps in planning and adjusting strategies for optimal profitability. It ensures that sales volume adjustments align with financial goals. Marginal costing offers valuable insights for decision-making by focusing on variable costs and contribution margins. It helps in maximizing profitability and optimizing resources. This method supports informed managerial decisions to enhance business performance. Marginal and absorption costing differ in fixed cost treatment and product costing. Marginal costing treats fixed costs as period expenses, while absorption includes them in product costs. This affects profit calculation and decision-making suitability. Each technique has unique advantages for different business needs. Considering non-financial factors is crucial when using costing techniques. Factors like quality, employee morale, and environmental impact affect long-term success. These aspects are not directly accounted for in financial metrics. Integrating them ensures comprehensive decision-making and sustainable growth. In conclusion, incorporating non-financial factors alongside marginal and absorption costing strengthens decision-making. This integrated approach not only improves business performance but also supports long-term sustainability. By understanding both costs and broader impacts, companies are better equipped to thrive in today's dynamic markets. If you have any questions, please feel free to reach out via WhatsApp or email. Thank you.